An early Christmas present for indebted South Africans as the Reserve Bank cut the repo rate by 25 basis points. The rate cut brings the repo rate to 6.75%, down from 7%, and the prime lending rate, the benchmark rate, which banks charge borrowers, will be 10.25%. This will put more money in the pockets of indebted consumers as they will be paying a bit less on their debt. For more, we're joined by Chief Economist at Antswisa Management Group, Miyelani Mkhabela. Miyelani, good evening. Thank you so much for your time. This announcement comes not too long after the Minister of Finance had announced an inflation target of 3% and not the upper limit of 6%. And of course, we know that the inflationary rally that we experienced globally over the last 3 years was quite intense. But to see that we're managing inflation in the way that we have to give us room to adjust monetary policy there a little bit is no doubtably good news. But to 0.25% isn't that big a step. How should we interpret this?
This is good news for all South Africans, and I think we must start celebrating that the 3% new inflation target with like an add of 1%, it's gonna make the South African corporate and individual consumers live better, mainly from socially, where I can start from. The purchasing power of money will be good, mainly for people with low income, it has been a problem when we are capping at 3 to 6%. But like when you look at businesses, we are gonna experience businesses that will thrive because the borrowing cost will be lower, and then small businesses and large businesses will be able to have access to funding at a lower cost, which that is good for the country. It is good for growth. It is good as well for whether it could be small businesses, informal businesses and large corporations. But at the same time, you look at economic certainty or certainty that is expected. So that gives us an advantage operating like advanced economies and other emerging economies, which will operate the same as advanced economies.
But doesn't that give a sense of artificial growth? Because bear in mind that we have nominal growth at around 0.8%, right?
Yeah.
When the rest of the world, on average, is growing at 3.2%, far above where we're finding ourselves now. We might feel the ease on slowing inflation, and I must qualify. Inflation, not deflation, because when you say inflation is slowing, people often think the prices of things are coming down. And it just means that the rate at which the prices are going up is a little bit slower than what it ordinarily would have been. So we have that slowing inflation, which makes us think that things are going well, but we're really only growing at 0.8%, lower than the rate that our population is growing.
But that is history. That is history of the target of 3 to 6%. With this now, this 3% is going to allow us boost investment. It will boost economic growth as well. And investment and economic growth create jobs. And I want to indicate this because there was a wrong myth when TM or Thabo Mbeki was running the economy, and then people who did not understand economics, they were saying growth, or it's growth with no employment.
Yeah, jobless growth is what they call this.
So if you look at that, that's a wrong myth.
Okay.
Growth translates to a job creation. It can sometimes not cover almost everyone, but like we'll start to see changes in the market because small businesses will be able to get money. So the
borrowing cost for small businesses, I think, is
it will be attractive,
important.
but the returns will be attractive as well. The social element that from someone who comes from the bank will be interested on is a lot of people, or the 80% of the population, have been borrowing at a very high cost. And now their bonds or their credit facilities are forced to go down, which that will ease them to have disposable income. And that's what we need, so that people start saving,
cash on that balance
people start to be investing. And I think that is the culture that we need for the country.
Miyelani, we're going to have to leave it there, unfortunately, very thin on time, but really do appreciate you coming in.